So, Christy, like looking ahead, as we think about more North American miners coming online, and presumably perhaps more renewables-focused miners within that group, what do you think that does? I think renewables and ESG were a significant blow to Bitcoin as its Q2 rally sort of came to an end. What do you think the prospects are for a fresh look at Bitcoin from institutional investors that are concerned about ESG? Is there going to be a there if they look? Are they going to find a better, cleaner Bitcoin if that's what they're looking for?
The jury's still out on that one, I think, in North America, because in North America, there are still quite a few natural gas possibilities. There's still quite a few, there is some coal, but a lot of it is gas. Not to say we don't have a lot of solar power and hydroelectric power as well. There's a huge mix. And I know that because a lot of these companies are really ramping up their infrastructure now, as opposed to dealing with old infrastructure that has, that was online before people were paying too much attention about ESG, they are making a conscious effort, if not to use renewables all the time, to try to make that part of their mix and to commit to carbon offsets. Take or leave that as you see fit. But carbon offsets are a part of their strategy. And they're becoming creative. And this is something that's been part of the Bitcoin mining ecosystem for quite a long time, because don't forget that the cheapest energy is often renewable. And it really is a race to the cheapest energy source if you're going to be competitive in Bitcoin mining.
Brad, if we could talk a little bit about institutional adoption. We've seen a few headlines break this week, I think. Can you kind of run us down who are the players from Wall Street that are making moves in Bitcoin over the past week?
Well, first, I just want to go back to, kind of the story of the mining and the hash rate and talking about institutional money. There's a lot of institutional money going into mining, setting up the operations and investing the capital to set up the facilities with the transformers and connections to the grid and everything, and also to invest in the rigs. And one thing I think is super interesting is that you are seeing, what's happening with the hash rate is evidence that the market signals are working, because price is here, $48,000, and people are putting in exahashes, because they can make money. And so it's this industry keeps calling for capital. In terms of, your question, CoinDesk broke the story this week that Citigroup is getting into Bitcoin futures, and Wells Fargo also set up a solution for private wealth clients. And that's just something that we've seen, is that, these huge banks sort of reluctant to be publicly, transparently, openly embracing Bitcoin, but they're still providing a solution to their rich clients because they don't want to turn those people away. And those people are demanding to invest in crypto.
We've certainly seen a recovery in the price of mining equipment alongside the rally in the Bitcoin price this August. And I wonder if you start to see then some of the capital that might flow into machines and infrastructure instead starting to flow into the spot market and perhaps fueling the other side of that virtuous cycle, if you will. Brad, any thoughts on kind of how investors might play that?
In general, this is an early industry. People are still figuring it out. And as we've seen, there's just this clock turning of, decisions are made that, okay, this is how we're going to get into crypto, or this is how we're going to get into crypto. And then it takes time. And then over time, you see these announcements. I would guess, the fall. Bitcoin's doing really well this year. It's the third year in a row. And I'm guessing, people keep talking of stocks being at record, but crypto's doing better. I would think those capital allocation decisions, we'll probably start to see a lot of those in the fall. I don't know. Just my guess, based on all the signals we're picking up.
Christy, let's close it out with a little bit from Ether. You and I were talking about this earlier. Ethereum analysts have noted that the Ether supply rate increase for at least one day this week was lower than the Bitcoin supply rate increase, obviously, the supply rate of Bitcoin being an important part of its investment story and stock-to-flow ratio being an important kind of analytical narrative. I wonder if you can comment a little on kind of what we should be looking at in the weeks ahead in terms of monitoring, whether Ether is setting itself up as a viable alternative to Bitcoin in terms of that narrative of limited supply.
Yeah, we're actually going to talk about Ethereum here on All About Bitcoin, are we? So, yeah.
It's okay.
A new Ethereum block is mined every 14 seconds, okay? And 5 Ether are created with each new block. And this is going to keep happening till, I guess, the end of time, unless they change their mind. There's at the moment, no supply cap on Ether. Bitcoin, on the other hand, has a hard cap of 21 million Bitcoins. That's it. It's hard-coded into the protocol. Roughly every 4 years, the amount of Bitcoin issued from each new block gets cut in half. So today, that's how we limit ours in Bitcoin. Every day, every 10 minutes or so, we get 6.25 Bitcoin. In the spring of 2024, that's going to get cut in half every 4 years till 2140, roughly. And then no more Bitcoin can't create more. With the last Ethereum hard fork, as a way sort of to control their issuance, and I don't mean we and they, I'm not Ether or Bitcoin, it's just this is all about Bitcoin. A new burning process was introduced as a way to control the amount of available Ether being issued. So under EIP 1559, transaction fees on Ethereum are split up into a minimum fee called the base fee, which is now burned. So that Ether is gone. And there's also a priority fee, and then there's the Ether. But it's the base fee, the transaction fees now that are getting burned.
It's that burning that is then sort of reducing the net supply rate.
That's reducing the supply. Yeah. Exactly. So as a result, the upgrade has eliminated something like 100,000 Ether, representing 36% of the new coins issued since August 5th, according to EtherChain. So the thing is that with Ether, it's that net issuance that's always going to be variable under this design, unlike Bitcoin, which is, tick tock, next block, that's what we get. So the devs for Ethereum are hoping for equilibrium in terms of how much gets burned and how much gets newly issued. And so far, the metrics are kind of working out that way, but it will always depend on how much use the network is getting, which will affect the transaction fees, the base transaction fees, which will then ultimately affect the burn rate. And it can always get tweaked in a future hard fork. This is another thing about Ethereum. These sorts of changes they happen. The Ethereum devs will go in and just be like, you know what, we should change it this way. We should change the issuance that way. We can hard fork to do this or hard fork to do that. And that happens. They tinker with the supply, and there's a precedent there. And that's fine. This is not a judgment call, but it's different from Bitcoin. That does not exist. And it's highly, highly, highly unlikely that Bitcoin would ever do that. So yes, there is a burn rate. And yes, the supply is starting to even out. But we're still at a point where we're not going to ever know how many Ether there are going to be ultimately. Although, we can kind of guesstimate, whereas with Bitcoin, we know, and it's part of the value proposition of Bitcoin. It's hard-coded right into it.
Does Bitcoin care how many Ether there is? It does not.
Not a chance. And I can tell you in the coming weeks, if we're looking ahead, how will Bitcoin respond to this? Bitcoin ain't going to respond to this. Bitcoin's just going to keep on going.